Hello everyone, welcome back to the chat room. My name is Ed Ponzi. Great to be here with you today. Hope everyone's having a good time out there. I'm speaking to you on Thursday. It is August the 21st. Got some great questions. Stock market just closed at an all-time high. When I say the stock market, I mean the S&P 500 in the U.S. Is, well, 1 minute from closing at an all-time high, but still underneath 2,000, which I think is interesting. I'm still not sold on this rally if the price cannot break higher, if the price cannot get above 2,000. If that index can't get above 2,000, then I'm not so sure that I'm a big believer in all of this. But I wanted to get to a question. First of all, somebody had a question about a particular stock, and I know why, because this stock had a big up day yesterday. There's the closing bell. I know the stock had a huge up day yesterday on really high volume. The stock is Hain Celestial, and person was asking, should I buy it? And, you know, from a fundamental perspective, it all sounds very attractive because the company, you know, they make organic groceries, you know, foods like that. And you know, if you're into the whole organic thing, and I have definitely, you know, put my toe into that water. I definitely indulge in the organic foods these days. I think it's a wonderful thing. If you're indulge in that, one thing you realize by their huge earnings beat yesterday, they crushed earnings and they really raised their guidance. They bumped their guidance way up, Hain Celestial. So with those fundamental factors being very positive, should we buy? And the answer is really no, because if you look back, you can see resistance is right here. So we have this huge up day on Tuesday, and you look at that. Look at how where that wick goes. That wick goes very, very close to this line. This wick goes very close to this high, and it pulls back to close a little bit beneath. Then it gaps up again. On Wednesday, gaps up very close to Tuesday's high and retreats. So I'm not a huge believer in this. I'd also like to point out, check this out. You see how the RSI became overbought on the daily? Now that in and of itself would never get me excited, but it is getting overbought right at resistance. And the last time that happened, the last time Hain Celestial became overbought at resistance, it was at the same price area, and it sold off very sharply. Okay, there's the previous overbought signal. So I think it was a great earnings report. I think, you know, Wall Street loves the stock, but I just don't think it's the right time to buy it. I think they've got a very bright future. But they also traded a very high valuation. I mean, the forward earnings on this, even if they meet their highest expectation, the stock's trading at 24 times next year's earnings. And one of their competitors, another company that makes organics, trades at 30 times next year's earnings, and that's WhiteWave. Look at that. That's actually a very pretty chart. I can't really buy either of them because they're so expensive in terms of their valuation is just too high in both cases. You know, but this stock has done nothing all year. Now, if it breaks out of that pattern, if it breaks out of that rectangle, then maybe we can talk. But I'd really rather, if it breaks out of that pattern, then you're buying it at an even higher valuation. I'd rather own this on a pullback. Maybe if the entire market pulls back, that's the situation you want. You don't want to buy a good stock or what appears to be a good stock if it's on company-specific weakness. If it's on general weakness, that's great. Say, well, we'd love to see some general weakness right now. Well, if you wanted to buy this, that's what you'd want to see. You'd want to see the S&P come down 50 points, and you can maybe get this stock a couple bucks cheaper. And then if you can get it a couple of bucks cheaper, you know what? You can buy it under resistance instead of right at resistance, which is never a good idea. Bottom line is, though, that these companies are going to continue to do well. Hain, WhiteWave, etc. They're going to keep making money. They pretty much, they're getting more and more outlets. Here's the thing. You have this Whole Foods Markets, right, which really specialize. It's a supermarket that specializes in this type of organic foods. And you can see the stock got destroyed, and you can probably even see the Head and Shoulders in there, right? Left, right, and the head up here. There's your Head and Shoulders. Okay, and the stock just gets crushed. Now, everyone loved it. Everyone loved this stock before. And look at this. It just went straight up for years. The stock basically quadrupled. It went from, actually, it went from like 10 to 65. That's crazy. It sextupled. And then it fell apart. Why? Are they building new supermarket chains that are going to sell all organic foods? No, not at all. They are building, they have already built. There are already existing supermarket chains that are now beginning to sell more organic foods. So if you go to, your typical U.S. supermarket, there's a section now for organics, and that section is getting bigger and bigger. And that's why this supermarket company, Whole Foods, they're getting beaten up here. Because it's not because, everyone said, well, we got to own this. This is a special kind of company. It's the only supermarket out there where you can get this kind of stuff. That was true a couple of years ago, but it's no longer true. Okay, so Hain, if you're an average supermarket and you want to stock yourselves with organics, who do you call? You call WhiteWave. Look at that chart. And you call Hain Celestial. And that's why these stocks are doing so well. They're also, both of them, WhiteWave and Hain, they're both takeout candidates. They're takeover candidates. Even though they're at high valuation, maybe a Kraft Foods or a Mondelez or, some typical food company says, hey, we have to get on board with this organic shift because it is not a fad and it is not going away. Okay, the shift to organics is, in my opinion, permanent. And why? Because I think people who take this up tend to stick with it. They like it. They enjoy it. I do. And other people I know who use organic foods feel the same way. Hain also noticed that now they're getting a lot of sales increases in the UK. So maybe this type of philosophy is spreading all around the world. I'm sure, hey, listen, it wasn't born here in the U.S., right? But it's becoming more and more popular, not just in the U.S., but in the UK and elsewhere in Europe. And so, so good to know. Hain and WhiteWave, if there's a big sell-off, that's probably where I'm going to be looking. We have other questions. I'm going to get to your questions on currencies next. I have a currency question. This one's on Euro Swiss. We had a great question. Hey, Euro Swiss, this currency pair has been drifting lower toward the 120 barrier. Now, as you know, I am long. I bought some. We don't need the volume anymore. Let's knock that out. I bought some here, I bought some more here, and if it keeps going down, I'm hoping to purchase even more. Right, at 120.50 is my next buy point. Right now it's at 121.03. The question is, it's been drifting lower. Have the Swiss changed their minds? Have they shifted their monetary policy? will they allow the euro to fall through this barrier? And I think you can see the barrier much better here on the weekly chart, right? 120 is the line in the sand. Now, first of all, let's take a look. See, here's the beautiful thing about this. I don't have to guess at what is the Swiss National Bank thinking. They're just going to tell you. They talk to the press all the time. They want the press to know what they're up to. Okay, so first, this is dated, by the way. I'm reading an article to you. I don't like pulling them up on my laptop because my laptop is not an Apple. So I'm reading it from my iPad. But this is on a website called swissinfo.ch. And just a little helpful hint out there, if you're looking for information about a particular currency, sometimes the best way to get it is to go to, look at, like if I want news on the Australian dollar, you can look in the Australian newspapers online and get it, and the same thing is true with Switzerland. So this is from swissinfo.ch. And Bloomberg. I've actually picked up a Bloomberg story. So this is actually a Bloomberg story from 1 week ago, less than a week ago. Today's what? Today's the 20th. So this is from 21st. This is from earlier this week. This is from Tuesday. The Swiss National Bank is seen maintaining its cap on the franc for at least another 2 years as the European Union struggles to gain economic traction. More than 3/4 of the respondents of the Bloomberg monthly survey of 23 economists say the central bank will keep its ceiling of 120, in this case it's a floor, right? They will keep the floor of 120 until at least 2016. Less than 10% they will believe that they will remove the barrier in 2015. And virtually nobody believes they will remove it in 2014. Okay, so the thought here is that if the European Central Bank doesn't raise rates, and we know they're not going to raise rates, then the Swiss can't really do anything. They just kind of have to sit here. So 39% of the respondents say that they're going to exit the cap in 2016 at the earliest. 44% say there will be no move until 2017. Now, before you get too carried away with these figures, I know they sound awesome. Just remember, these are just opinions of economists. These guys don't know. Nobody knows per se. But this is what is currently very strongly believed. Let's just put it that way. 44% say 2017, 39% say 2016, and like 7% say 2015. It's just not that many people think it's going to happen. Now, in July, the Swiss National Bank's president, a guy named Thomas Jordan, was interviewing with a German magazine. And he said that the cap would remain in place for the foreseeable future, which is really what they've been saying for years, and it's been true for years. They've been saying it since 2012, and it's been true. So I guess what I'm saying by reading this to you is that there's really no change expected in what we're seeing from the Swiss National Bank. And again, that comes from swissinfo.ch. Great little piece there. Great question there. Thank you so much. We do like your questions. Please do send them in to info@edponzi.com. We're more than happy to try to answer them for you. We usually do a pretty good job. We have another one here, another question coming up. This is about stocks, or as my friends call them, shares, right? In the U.S. we call them stocks. Everywhere else they call them shares. Here we call them stocks. So those two terms are interchangeable as far as I'm concerned. This pertains to the market cap and valuation of a stock. How does a company determine how many shares to issue? If they want to lift the cap, can they not simply increase the number of outstanding shares to increase the cap? That's a great question, actually. That's actually kind of a brilliant question. Let's pull something up here. Let's go to like Apple stock price, Google finance. We're pretty happy about it. We're pretty happy with Apple these days. So here you see the shares outstanding. And it basically says 6 billion, right? It's 5.99 billion. We'll just call it 6 billion shares outstanding for Apple. So each share is a piece of the company. So you could say that Apple has been divided into 6 billion pieces. Okay, so think of it as an apple pie, right? It's a very huge, it's a big company, so it's a massive pie, and it's been cut into 6 billion pieces. Could the company just issue more shares, more pieces of apple pie? And would that drive the value higher? Now, this is tricky. It would drive the number of shares higher, but remember, the shares collectively represent the value of the company. In other words, the world believes that this company is worth this much, $602 billion. If the company prints more shares, the world is not going to believe that they are adding value. So there will be more pieces of pie, but the pie itself will not get bigger or smaller. So in other words, if they add more shares, the price probably falls so that the market cap stays the same. Because really, this is where the world believes Apple is worth. The world believes Apple is worth $600.74 billion. That's the pie. The pie is cut up into this many pieces or shares, about 6 billion. Cutting it into more pieces doesn't make the pie bigger. It just makes the pieces smaller. Does that make sense? It's a brilliant question. Okay, cutting that pie into more pieces doesn't make the pie bigger. It makes the pieces smaller. The pie remains the same. This is the pie. The pie is going to stay the same. The number of pieces is going to increase. So that means each piece, if the pie stays the same and the number of pieces of pie increase, therefore the pieces become smaller. In other words, the shares drop so that the true value is still reflected in the market cap. So it doesn't really matter how many shares you have. That's a great question, by the way. And it shows that someone is thinking outside of the box. I love that. So please do continue to send those fantastic questions my way. Okay, wow, good stuff. You know, that's one of the things you notice about the room and being in here is that the questions just get better and better. At least that's my perception of it, is that the questions just get better and better. And that means that people are learning and they're thinking, and it's a good thing. Okay. All right, gang. Now, yesterday was a great day for us because, as you can see, the second target of 133.05 was hit in our Euro-US dollar trade. You know, I was thinking that the meeting at Jackson Hole would be the event that would either drive this thing down or to our target or drive it up to hit our stop. And the Jackson Hole meeting has started. I can see as I look over at my television right now, they're interviewing Charles Plosser from the Philly Fed. So, you know, Jackson Hole is kind of a big deal. Now, why does Jackson Hole matter? when Bernanke initiated the very first United States QE program, he did it in Jackson Hole. Now you've got Yellen is at Jackson Hole for the first time as the Fed chairperson. Guess who else is there? Mario Draghi. You think it's a big deal? I think it's kind of a big deal. I think you've got, well, I think the whole world is watching Jackson Hole because you've got Yellen and you've got Draghi out there. So it's like, you know, if you had, you know, a concert featuring Metallica and Guns N' Roses both together, it would probably draw a lot of attention. Well, maybe not today, but maybe 20 years ago. But you get the idea, though. It's like this is the center of attention. The whole world will be watching. Every newspaper is sending a reporter to Jackson Hole and a camera crew, and everyone's going to be watching. So if Draghi wanted to do something historically significant, he could lay out his quantitative easing plan at Jackson Hole maybe tomorrow, and that might send the euro flying. And, you know, I'm hoping if it does that it'll send it down to our third and final target, right? So, you know, you know, just to refresh you, just a little refresher on this, the whole trade started when this black line broke. We considered 135 to be a huge support level. In fact, we leaned on it for a buy. Remember here? This is where Draghi first mentions quantitative easing. We go right down to 135 and go flying back out of it. We come back down to it. Now it's a support level. We buy the euro. We actually make some money before we get stopped out. You know, we actually made money, I think, on the first portion of the trade and broke even on part 2 and 3. Then it comes back down. We say, well, these candles are kind of big. We don't want to buy it. We're not in a big rush to buy it. You see, we didn't buy it here either. We waited for this and this and this and this. And then we said, okay, let's buy it. Here you see the big red candles again, and here you see this, this, and this. But it's like, there's no bounce. Where's the bounce? There's no bounce. Boom, it breaks. The fact that there was no bounce was your clue that it was going to break. And when this big candle breaks down and closes under 135 support, that's when it's time to get short, and that's why the green line is there, because that is our entry point. Entry point was 134.65. And the first target was 134.15 because of these resistance areas here. The reason why I'm explaining all this to you is you can do a million trades like this over the course of a lifetime if you just think about how did we put it together. In other words, if you understand why we did it the way we did it, then you can duplicate this for the rest of your life, and you don't have to, you know, create new strategies every 15 minutes. You just do what works. That's what we're doing. I mean, there's no indicators on this chart. Where are all the moving averages and Bollinger Bands and where's all that stuff? It's just a bunch of lines. It's all it is, and it's working like a charm. So target 1, 134.15, you can see why we use that. Double resistance up there back in last year, middle of last year. The second target we used because of this area, 133.05, was a big support area, and it's just above a round number of 133 even. And we're through there, and what I do is I make that line dotted because it's been hit, and this line is solid because it's not been hit. So to go from the green line to the first target, that's 50 pips profit. The green line to the second target is an additional 160 pips. If the price now comes back to the first target at 134.15, we will be stopped out for a 50 pip profit on the third portion of the trade because that's the way it's set up. So, you know, if it comes back up above 134, man, we'll get stopped out. But look, we only have 1/3 of the trade left. We made 15, we made 160, and if this one hits, we'll make an additional 350 on the last piece of the trade. If it doesn't hit and we get stopped out, we'll make an additional 50 here. So it's just a question of how big of a win does this turn out to be. Even if we get stopped out now, it's a great trade. because we hit 2 targets. We're 2/3 out of the trade. And if we make it to that last one, then it's just, you know, that's just the icing on the cake. That would be nice. But we have no idea what Draghi's going to say or how the market's going to react to it. It's just my personal speculation that he might decide to drop a bomb at Jackson Hole just because of the historical significance of the place, and I'm pretty sure he gets into some history books if he does that tomorrow. I'm pretty sure he gets into some economics textbooks. There's, you know, if he drops a big one tomorrow and says we're going to do QE in Europe, and he does it at Jackson Hole, I'm pretty sure that means Jackson Hole gets a chapter in an economic book, kind of like Buttonwood. You know, Jackson Hole is going to end up getting its own little chapter, a little mini chapter, and that mini chapter is going to have to mention Bernanke, and it's going to have to mention Draghi, and who knows, maybe it'll mention Yellen too. We don't know what she's going to say either. So all this is coming up, and people, you see all these articles, people try to guess ahead of the fact. Ooh, what are they going to say? They're going to say this, they're going to say that. Nobody knows. Okay, I mean, I'm speculating, but you haven't seen me change anything based on what I'm saying. I'm still following the same old plan on Euro-US dollar that we've been following for a month. And that's how long we've been in this trade, gang. If it seems like we've been in there a long time, that's because this happened a month ago. That breakdown beneath 134 was on July 22nd. Today is August 21st. So it's been a month. And who knows? We might be in here another month. I don't really care. You know, if you think about it, I've spent a lot of days at the beach during this past month, and that didn't change anything. It didn't get me out of the trade. It didn't make me change my plans. You know, a lot of things have happened. There was a non-farm payroll report in there. There was a lot of things that occurred, and none of it caused me to change my plan, not even by a little bit, not even by a small amount. Okay? So something to keep in mind. Okay? So look, you're making money, you know, it's a beautiful thing. And now let's round up the stocks. Look at that. We pulled back to that 100-day moving average, and it just shot out of there it was like a rocket out of there. The 100-day moving average has been the story on the S&P 500. There's the bounce. And there you go, new highs. But the new highs are under 2,000. So does the market chicken out ahead of a huge round number and Jackson Hole? I don't know. I'm going to wait and see. I'm going to wait and see. Maybe the market chickens out here. I don't know. If it breaks through, then we're going to be a lot more bullish. If we start closing above 2,000, then we don't really have any choice but to become bullish. By the way, one of the things, an interesting note that came out of Japan is that in Japan now they're talking about just buying stocks, like you know how they've been buying bonds with quantitative easing. Now they're just talking about just buying stocks. I mean, if any of that spills over into the U.S., it just drives the U.S. markets higher. If it spills over into Europe, it drives the European markets higher. Okay, and the same thing true if the ECB and Draghi announce quantitative easing, that's going to spill over into other markets. You know, the whole point of quantitative easing is to drive interest rates down, correct? Does anyone know what a 10-year German bond, or Bund as they call it, is yielding right now? A 10-year bond in Germany yields 1%. Quantitative easing is designed to drive that rate lower. Well, it's already at an all-time low. So do you really think it's going to make that much of a difference? It might generate some, I don't know, confidence, but I don't know if it actually changes anything. Okay? Anyway, so that's your stock market. Let's take a look at some stocks. Apple, of course, all-time high. What more can you say? JCPenney broke out, gave some of that back today on the breakout, but we're still above 10. Remember, we bought this at $8.60. So, you know, every time this thing moves 86 cents, we're up 10%. So I'm having trouble keeping track of it now, but you know, we're up somewhere between 15 and 20% on JCPenney. So nice, nice, nice. Dean Foods just kind of, yeah, just laying there. Big disappointment there. Not really a huge disappointment. Like I said, I think it's one of those stocks that's going to be an overnight thing. On the short side, we got our butt kicked the other day, man. This TJ Maxx, just look at this. We're short this thing. Oh, that hurts, man. That hurts. And really, I'm just waiting to see if the market chickens out at 2,000 at this point. Because I was wrong on TJ Maxx. And I just got my, you know, it's a shame because, like, we made so much money on stuff like Apple and JCPenney. And then, like, something like this comes and takes some of it back. I hate to see that happen. But yeah, I got pounded on this one. If the market breaks through 2,000 and it appears like it wants to go higher, I'll just dump it. The only reason why I'm still holding it is because we're right up against psychological resistance. You know, S&P could pull back 50 points here. If it does, I probably still get out of this, but I get out of it at a better price than the one I'm sitting in, you know, right now if I get out. So kind of surprising that this one did what it did. We are still short the Lulu. And this thing is not bothering me at all. This is, it doesn't, you know, stock market, does this look like a stock? I mean, the stock market's hitting all-time highs today, gang. Look at this chart. It's hideous. Imagine what it would do if the stock market went down, right? Not a pretty thought. And the last of our shorts is KMB. We shorted this at 107.60, so we're down $1.50 on a $109 stock. We're down. We're really not. We're down not much at all on this. Like 1%, between 1% and 2%. It's not a big deal. We're down. Yeah, we're down close to 2%. I think. Not a big deal, right? Because why? Because our position sizes vary based on the price of a stock. You're not going to buy $1,000 of Apple and $1,000 of a $5 stock and think that it's the same thing. It's not. Or you're not going to buy 1,000 shares each, right? You know, that would be crazy. And you know, you're not going to buy 1,000 shares just, you know, without thinking. You're going to size your trades so that your risk is in line, and that's what we've been doing. So the chart still doesn't look that great if you ask me. Remember, stock market hit an all-time high today. This thing, meh, it's not doing so great. We'll see. So we've got 3 shorts, we've got 3 longs. If the market pulls back here, our shorts are going to start to look better. If the market breaks out from here, we'll probably just cover our shorts. But I'm waiting to see whether it breaks up first or down first. We're right at that crucial point. There's no point guessing. I'm just going to try to wait and see what happens. Okay, gang, that's going to wrap it up, everyone. Have an enjoyable day and enjoy your weekend after that. And hopefully Jackson Hole will be interesting and maybe we'll see some volatility. I guess whatever happens, we'll be talking about it just a few days from now. So everybody have a wonderful evening or day or afternoon, wherever you happen to be. My name is Ed Ponzi. Thank you very much for listening, and I'll speak to you again in just a few days. Take care.